As we approach the end of the year, it's interesting to look back and see all of the ups and downs the markets have provided us. For most of us, those ups and downs have given us both positive and negative returns. The gains are obviously good, but what about the losses? Do we automatically assume that because an investment is down that it's not profitable?
Ideally, every investment will result in a massive gain, but that's not always the case. However, investments that do yield a loss have a valuable purpose, and that's a tax shelter. The basic idea is this: capital gains taxes are paid on investments sold with a positive gain during the year. Investments that are sold at a loss can be used to offset the capital gains on your portfolio, thus reducing your taxes payable.
So if you've triggered capital gains this year and you have an investment that is currently in a loss position, it makes perfect sense from a tax perspective to sell the investment to trigger the capital loss. In addition, you can carry losses back 3 years, so the government allows you to apply the losses not only to gains realized in 2015, but also to capital gains realized in 2014, 2013, and 2012 as well.
Reviewing your tax returns from those previous years is therefore very important to see if you can recover any capital gains tax that you paid in those prior years. Alternatively, if the opposite is true and you have triggered some capital losses this year and previous years, now might be a great time to crystallize some of the capital gains on some of your investment holdings.
There are a few things to note if you plan on doing any tax loss selling. First, the sales transactions must be initiated by December 24th for Canadian securities and by December 28th for US securities in order to settle during 2015. Since December 28th is a holiday in Canada due to Boxing Day, you should consider placing any US transactions by 1 p.m. on December 24th to ensure that the transactions settle in 2015.
Also, any capital losses must first be applied to any capital gains realized in the current year before you may apply them against gains from previous years. It should also be noted that the balance of unused capital losses is carried forward indefinitely and can be used to offset capital gains in the future. If you should die with a balance of unused capital losses, the losses can be used to offset any income that year or the year prior to death.
Securities that have been sold to trigger a capital gain can be immediately repurchased should the investor wish to do so. However, if a security is sold for a capital loss, then any purchases of the same security within 30 days will result in the capital loss being denied for tax purposes.
So if, for example, you sold shares of Royal Bank at a loss, you cannot repurchase the Royal Bank shares for 30 days, otherwise the loss will be denied. However, you could purchase shares of TD Bank immediately so that you're still invested in the banking sector and the loss on the Royal Bank shares would still be permitted.
So that's all for today. Be sure to follow us on our Facebook page for regular updates. Thanks for stopping by, and we'll talk soon.